Welcome everyone. I want to thank you for taking the time to be here. I've titled the presentation The Great Reset Strategy, and I want to be clear about what that means. We aren't trying to be dramatic or alarmist with the title. We are calling it a reset because the fundamental rules of engagement for buying and selling in Prince George are changing as we look towards 2026. For the last few years, we have been operating on autopilot, but now we are resetting expectations, we are resetting strategies, and honestly, we're resetting our mindset. The headlines you see on the news were designed to scare you, but if you look at the actual data, there is a clear path forward. Today is about moving past the fear and focusing on the math so you can win in this new environment. Quick disclaimer before we get going, I am a licensed real estate agent, not a financial advisor or a mortgage broker. We're going to talk about some high-level math and strategies today, but this is for educational purposes only. Market conditions can change, and everyone's financial situation is different. So please consult with your own professionals before making any big moves. Let's get into what we're going to be chatting about today. Here's our roadmap for our time together. We're going to break this down into 3 specific pillars, so you walk away with a complete picture. First, we're going to look at the math. This is critical because renewal letters are hitting mailboxes right now, and for many people, they contain a nasty surprise called the dead money trap. I need you to understand exactly that amortization math and how it works so you don't get stuck treading water. Second, we're going to look at the map of Prince George. Prince George is not one big uniform market anymore. We are seeing hyper-local divides, specifically when we compare areas like College Heights against Heritage. Understanding these micro markets is how to avoid overpaying. And third, we are going to cover the strategy. We're going to talk about how to exploit the gap in the market and how to find what I call boomer opportunities. This is an actionable playbook that you need to take home. So, let's start with a reality check. We need to admit that the era of dating the rate is officially over. Back in 2021, money was essentially free. You could get a mortgage for 1.99% and it was incredible. But it also made us a little lazy because you didn't have to be strategic to make the numbers work. You might have overpaid because there was 10 other people bidding against you, but it was generally pretty straightforward as long as you could handle the monthly payments. Now, as we look at 2026, we're facing a reality check of rates settling around 4%. The old advice was to marry the house and date the rate, assuming rates would drop back down to zero. That is dangerous thinking now. We are transitioning from a uniform market where everything went up together to a split market. In a split market, you cannot rely on the rising tide to lift your boat. You have to be precise or you will get left behind. Please pay close attention to this slide because this is the single biggest financial risk you face right now. I call this the dead money trap. Your average house in Prince George is around $500,000. So in 2021, if you put $100,000 down, let's just say for this scenario, you would have a $400,000 mortgage. On a standard 5-year fixed, you were paying about $660 in interest, but you were paying down over $1,000 in principal. You were building wealth rapidly. Now, let's look at 2026 scenario. Even though you paid your mortgage down to approximately $332,000, your interest payment has almost doubled to over $1,100, which hurts your cash flow. But the real trap is what happened to the principal. Your principal paydown has now shrunk by 36%. You are paying more total money out of your bank account every month, but you are keeping less of it for yourself. That is the definition of paying more to keep less. If you don't have a plan to counter this, you are just renting your money from the bank. Building on this trap, let's talk about the hidden cost of renewal. When you get that renewal letter, your eyes are going to go straight to the monthly payment. You think, okay, money is tight, but I can squeeze this into the budget. Stop right there. That is the wrong metric. The payment shock isn't just the monthly total, it is the loss of efficiency. Every single month, you're paying down $375 less debt than you were before. Over a 5-year term, that is tens of thousands of dollars in lost equity that you will never see again. My advice here is simple. Don't be fooled by a manageable monthly payment. you need to look at your amortization schedule. If you are just making interest payments, you are standing still. We need to structure your mortgage so you're actually moving forward. So let's look at interest rates. And you might be looking at variable and fixed right now and wondering, well, what's the difference? So this is probably the number one question I get right now. People see the news on that the Bank of Canada is cutting rates, and they expect to see the 5-year fixed mortgages drop through the floor the next day. But then they go to the bank and realize the rate hasn't barely moved. Here's the thing. You have to understand fixed rates do not follow the Bank of Canada, that they follow the bond market. Think about it like this. When you lock in a 5-year fixed rate, the bank is basically packaging that debt and selling it to bond investors. Now, these investors are looking at the long-term picture. They are terrified of inflation. If an investor thinks inflation is going to stick around for a while, they're not going to lend their money out cheap. They are going to demand a higher yield, a higher return, to make sure their money doesn't lose value over time. So look at the graphic on the screen. It is like a teeter-totter. One side, you have bond yields and inflation fears, acting as this massive heavy weight. As long as that weight is heavy, it keeps the fixed mortgage rates on the other side propped up high. Until the bond market is convinced that the inflation is dead and buried, those fixed rates are going to stay sticky. They are stubborn, so don't wait for the Bank of Canada announcement to time your fixed rate mortgage. You need to be watching what the bond market is doing instead. So now we've talked about kind of where interest rates are heading, also the difference between different rates. Let's check out some risk profiles, okay? So when it comes to financing any strategy, you have to choose your risk profile. There's no one size fits all anymore. So the first one is the sleep at night 5-year fixed on your renewal. You lock it in and forget it. You might really like this option because you rode the variable up and down for the last 5 years and you're kind of just sick of the chaos. The second strategy is the hedge. You can put it into like a 3-year fixed. This is for people who think rates might drop but want some protection over the next couple of years. And the third option is to ride down the variable. High risk, potentially high reward if cuts come fast. But be careful, the 5-year fixed on the first strategy can be an anchor. If life changes and you need to sell in the 3rd year, the penalties can be massive. That is why I often suggest the bridge. You pay slightly more rate right now to have a shorter term, so you're free to renew in 2029 when the market environment will likely be completely different. So let's get into a little bit of strategy and exactly what you're looking for. This particular strategy I'm calling the golden ticket or the boomer time capsule. You want to find a house that has perfect maintenance. And I mean a new furnace, a new roof, new windows. The big ticket items are done. But it has dated finishes. We are talking pink carpet, oak cabinets, and floral wallpaper. It's usually the first time in the market in 30 plus years. Here's the play though. Buy the bones, renovate the cosmetics. Most buyers today are lazy. They want HD TV ready. If you're willing to rip up some carpet and paint, you can build massive equity before the flippers even arrive. This is going to be a huge opportunity over the next couple years and even over the next decade as boomers downsize and they realize they don't need these larger homes that they raise families in. And basically there's going to be a huge opportunity to get some generational lots. These lots have really like you drive into these lots and you're pulling into a fully treed lot, driveways long. It's just like, it's just gorgeous when you go into some of these places. And those are really going to be coming up for sale over the next couple of years. And once people buy them, they might not sell again for, generations. So it's really a great opportunity to get into. But let's talk about maybe where we're going to start looking. Let's head into College Heights and talk about the Domano Divide. College Heights is one of the most popular areas, but it does not all create equal. In Lower College Heights, you are looking at homes built in the 70s and 80s. There's incredible value here. You get more square footage for your dollar. However, you have to be vigilant. A lot of times there can be lack of maintenance and latent defects in these properties that you have to really watch for and make sure that you can get insurance and you can get lending on these properties. A lot of them are really well taken care of, and they're affordable for the first time families. And you can get really great schools. Malaspina and the high school is right down the road. Now, if we go in Upper College Heights, which is again Lower College Heights, Upper College Heights is kind of the local slang for this. But when you go up the hill from Demano, you're going into St. Lawrence Heights and Southridge and stuff like that. That's what a lot of people kind of talk about and they call Upper College Heights. Now, you're looking at 90s and 2000s build here, but you have to be watching out for preserved wood foundations. You need to identify these immediately because it changes how lenders and insurers look at the property. You're going to be able to identify these ones because they're going to be 2000s, kind of builds, 1990s builds on a really nice street for like $500,000, and it's going to kind of throw you back a little bit, and you're going to wonder why it's such a great deal. And these can be really good properties for people that are just trying to get in and purchase properties in a great neighborhood at a decent price. And a lot of preserved woods are actually really well taken care of, and you can get full structural reports on them that show that they're okay. So it's really a comfortability thing, but it's something to keep in mind. When you look up Upper College Heights, there is also a lot of development going on up there. So if you buy in certain neighborhoods, you might actually get the noise of builders for quite some time. But it has Southridge Elementary up there, which is a beautiful elementary, and it has really quick access to Walmart and Home Depot and Canadian Tire, and the big box stores are basically just up the road. So it is something to consider, but there is price differences. And, you might compare College Heights to more kind of the kindred cousin of Heritage. So while everyone is fighting over College Heights, Heritage has become kind of the quiet cousin of the market. It's sitting there quietly offering massive value, specifically in areas like, I particularly like Neff, Thacker, and Zamero, where the backyards of some of these places back on to green space. For example, Neff and Thacker back onto this huge field out back where I thought they would build the park there years ago, but they haven't. And so you can just kind of look off your back porch into a bunch of green space. And Zamero, a lot of these back on to Moores Meadow. So you get direct access walking into Moores Meadow, and you look out on your back deck and you just see trees. So they're really kind of these underrated streets that you kind of have to have local knowledge about to know where they are. But I live I live in Heritage right now, and I was born and raised here. So my parents live here now, and they're in the same house that I grew up in, and they really no plans of moving anytime soon. So for that reason, College Heights is kind of younger families, kind of up and coming. There's still some baby boomers up there and things like that, but Heritage seems to be a little more slower paced. A little more baby boomers around, but it's generally pretty quiet up here. And although there's a ton of kids going to Heritage, right now they're about over double capacity. So these elementary schools should handle about 200 kids. Now, I think they're around 450 right now. Besides all that, streets are pretty quiet, everything's pretty quiet, and generally people take care of their, lawns. The maintenance is immaculate. And boomers take care of their properties. So at the end of the day, though, you really want to pay attention to Heritage Elementary. Again, it's got around 450 students around there, so it's double capacity. There's portables out back. That's the reality of it. So just really make sure that you're checking into it and seeing if you want that. And it's not bad, it's not great, it's just really preference at that point. But if you're a young family moving, there specifically for that school catchment, you should double check that availability before you write an offer and just make sure that your kid can get in there. And this is kind of a hyper local detail that saves you a massive headache later. So let's move off and let's talk a little bit about some investing. So cash flow versus headaches. And so I get a lot of people calling up from the Lower Mainland, and they're interested in the VLA. And the VLA can be really great prices, and you can get decent rents out of there, and the rents are somewhat comparable to, they're lower than the rest of town, like Heritage or College Heights, but they're not that much lower, and you can buy these places for significantly less. But for the investors in the room, We need to have an honest conversation about the cash flow versus headaches. You can't have it all. If you want the lowest entry cost, you can go to VLA. Miller Edition or South Fort George are actually kind of on the fringe of VLA. So this is sometimes where I let people know, hey, maybe go check out places like this. On paper, the numbers look great in the VLA, but the reality is high tenant turnover and their management intensive properties. You'll earn every dollar of that cash flow. On the flip side, you can pay a higher entry price in a more stable neighborhood. You get a tenant stability and a long-term consistency and less headaches, but less cash flow. So it's kind of a trade-off, right? So you just have to kind of know that balance. You make less monthly cash flow, but you will sleep better at night. And the last kind of pro tip, this is one I'm just kind of throwing in there right now, is looking at Pinewood. It is a hidden gem, I think, that offers, kind of the pine cone down the road. Pine cone's a little more executive lifestyle, but at a little more of a discount. You still have great access to Ginter's Park. They have a nice little cute elementary school in Pinewood. And this is a spot that I've actually thought about moving to. And you're on Ospika. It can be great access everywhere. You're within walking distance to CN Center for events. And it's a nice little pocket that I think a lot of people just drive by on Ospika and they never really notice. So that being said, keep that in mind. And investors, we can always chat about what you're kind of thinking, but generally I let people know, like, hey, try and go on the fringe of the VLA if you're kind of thinking about investing, places like Miller Edition, South Fort George, stuff like that. There can be a lot of great opportunities in those areas. But let's move on. I just want to talk a little more about what's coming this year, and it's kind of the tale of two markets. They are behaving completely different. First, you have the luxury market, let's call it 750,000 plus. This market is soft right now. Higher interest rates means people bid less on the more expensive stuff because you need to make more money and your mortgage is going to be higher, very simply. Inventory is sitting because the buyer pool for these expensive mortgages has shrunk. If you're selling luxury, you need to be patient. Then if you have like an entry-level market, 350,000 to 550, this is kind of your Heritage and College Heights kind of buying range. This market is hot right now because this is where the brawl is happening. If you're trying to break into this bracket, my strategy is kind of to buy the ugly duckling on the street. Look for the house that smells like a wet dog. That's the descriptive word that I'll use, but it has good bones. That is where you build sweat equity. Also, don't be afraid to drive until you qualify. Expanding your search radius just 10 minutes can drop the price significantly. Next, let's talk about the gap strategy. So yes, the luxury market, $750,000 plus, is sitting, but in times of slow market, the luxury is going to fall in price sooner and fall a little bit more if interest rates stay high. So if you can bridge that gap and date the rate for the next couple years, sometimes in a slow market, that's the time to actually push up and upgrade. So this is one of the most powerful strategies for anyone looking to upgrade. It's called the gap strategy. Everyone is afraid to sell their home because prices have softened, but you need to look at the relative math. Let's say you have a starter home worth $500,000 and you want a dream home worth $900,000. If the market drops 10%, your starter home loses $50,000. And that hurts, but the dream home also drops 10%, and that's a loss of $90,000. The gap between your home and your dream home just shrunk by $40,000. Moving up in the down market actually shrinks the distance between you and your goals. This is the silver lining of a soft market. And generally people will try and move up when interest rates are low, and then the bidding war happens, and then for the $900,000 house they'll actually pay $1.1 million, and then you kind of get stuck in that higher mortgage when interest rates come up, and that's where we are now. So it's kind of sometimes counterintuitive, but it's something to keep in mind. Second to last slide here, let's talk about the execution. These are just some, strategies that maybe we can go out and use this year, but this is where we turn the theory into action. Here's some execution stuff. Number one, purchase plus improvements. When you buy that ugly duckling, do not put the renovations on a credit card at 20%. Use this program to finance the renovations into your mortgage at 4%. That's cheap money. Number two, extend and blend. If you're struggling for cash flow right now, you can look at blending your rate and extending your amortization. It lowers your monthly obligation instantly. The goal here is simple. Use the bank's money to force appreciation. Don't just wait for the market to go up. Make the house worth more. So that's it. That's the presentation today. To wrap this up, you are moving from an era of free money to the era of smart money. The headlines are going to continue to be scary. They sell clicks, not houses. But as we have seen, the math reveals the path. Success in 2026 requires a plan based on hard data, not public sentiment. I am a real estate agent, not a financial advisor, so please consult your professionals. But if you are ready to stop guessing and start executing on a plan that builds real wealth, let's talk. Thanks for listening and have a great day.